Hello, everybody, and welcome along to the September edition of the market update for Portal Asset Management, Portal Digital Fund, Radiance Fund, and also the Investor's Guide into investing into this space. My name is Deryck Graham. I'm the CEO of Portal Asset Management. Importantly, today, Mark Witten, CIO of Portal Asset Management. Good morning to you, Mark. How are you?
Good, and yourself?
Yeah, excellent. May I say that you're going to start this discussion with September as a choppy month. And it's fair to say that every month tends to be a choppy month in this particular space because it's volatile. But it's interesting to note that the name September in this space is regularly referred to as Rectember, and October is regularly referred to as Uptober. But September was a good month, wasn't it, Mark?
It was an interesting month in that the first 6 days of the month, should we say, there was quite a significant sell-off. The intra-month losses, I think Bitcoin was down 10, 11%, ETH around 14, the market itself around 12%. And I think a lot of that was the increase in geopolitical risk that we've been seeing, particularly in the Middle East, which could potentially push oil prices higher and inflation higher. So that was a concern, but then that seemed to unwind pretty quickly. We then saw a really strong rally. For over 2 weeks, the market rallied and then settled down. But then that rally, unfortunately, fizzled out into month end, where we saw a bit of a pullback, particularly on the last day of the month, which is generally unfortunate because funds are marked, most hedge funds are marked on the last day of that month. So I think what we've noticed, it's difficult to call it from a seasonal perspective. There used to be the old adage of sell in May and go away, and now you're talking about Rectember versus October. But what we've generally seen over the past 6 months, we had a very strong bull market between October and call it March. And then from April to September, we've had a very sideways trending, but very choppy market. And the one positive aspect we've noticed is that there's a lot of support around the $60,000 mark for Bitcoin and for the market itself in general, the CCI 30, when we're around those levels. There's a lot of support, a lot of buying that's coming in. And I think that's setting us up in terms of consolidation. There's definitely now, I think we're being set up for the next push through in this up leg we've been pushing for in Q4 this year and into the Q1 of 2025. Yeah.
Look, you were saying that Bitcoin was range bound between that sort of, for the last 6 months, between $53,000 and $70,000, and that there's really supported around that $60,000 mark. You've also got the view that the macroeconomic conditions have this adverse effect. And it's interesting, we're speaking now in early October when Israel has undertaken its retaliatory attacks on Iran, and the market has immediately reacted to it. But it seems to me that the market hasn't stayed often with these reactions regarding world shocks like that, but that does tend to stay and react to liquidity, availability of liquidity, interest rates and general economic conditions. What are your thoughts on that?
I think it's often a case of bad news in some ways becomes good news for the markets because if anything, the liquidity in the printers will be turned back on. What has changed, what has been a shift in the past, call it month and a half, is that the Fed finally cut rates. It looked like they were waiting for, I don't know, maybe for the Japanese to hike theirs or for China to start their stimulus strategy. I'm not quite sure what their thinking is, but they finally did cut rates, and the market then quickly formed a consensus that rates were going to be cut a lot quicker and deeper than was expected. The one thing that does concern us is generally when the Fed starts cutting rates, it foreshadows, 12 to 18 months later, you often see a real correction in the economy and in the global, in the markets themselves. So we are watching quite closely to see if the underlying conditions are developing as we expect. There was a very strong jobs report out this week, which pulled back interest rate cut expectations. At the same time, the Chinese announced this massive stimulus plan, and then that hasn't seemed to have been delivered. So the market was up almost 20%. Now it's given back more than half of that. So the liquidity, the markets and the crypto space is no exception, are being driven, I think, by expectations of global liquidity. The world is unfortunately in a bit of a stressful situation in terms of geopolitical risk, because the concern is that it now starts spreading wider and wider. It was Israel, Hamas, West Bank, Gaza. Now it's into Lebanon. As you say, it's a proxy against Iran. The USA will get involved. So it can escalate quite a bit. I think all in though, net, it is positive for the space. It is positive in terms of its borderless and permissionless and secure way of transferring wealth and storing wealth. At the same time, though, I think one of the things that we're continuing to watch is if we don't see an improvement in liquidity, then particularly on long duration risk assets, as we always call them, then you tend to have less of that stimulus and that push, and the market will grow organically, as we always believed it would, with the rollout of further DeFi type protocols and layer 1, layer 2s and so on. But ultimately, we do want to see, I think the underlying economies are calling for a reduction in rates in terms of giving us some sort of stimulus, because the cost of living, the difference between inflation seen at Wall Street versus Main Street is very different. The cost of living, particularly for consumers, is way higher than is sustainable for them at this point in time. And you can see it in the housing market and employment rates. So I think those are the two main events. We know, Deryck, if you take a look at crypto-specific discussion points, which you attended, Token 2049, and you also had Bitcoin 2024 in Nashville. Bitcoin 2024 definitely had more of a political feel to it. It had very big endorsements from the Republican Party, with Trump stepping up, as well as RFK Jr. saying that they would like to create a reserve, a Bitcoin-based reserve. So that was, I think, a big change in a regulatory perspective. There was a step change there in our mind, going from this sort of headwind and Operation Choke Point to now being, well, we actually want to create the biggest crypto reserve in the world. And then you attended Token 2049, and as you said, there was 25,000 delegates there, which was double what it was last year. And it was a good mix of service providers, developers, investors, and the outlook is extremely positive. I think the adoption curve, where we are on the adoption curve, is ahead of expected. I think we'll get to 1 billion users way before 2030. So net, the global macro is challenging, but not terrible. The underlying crypto, what we're seeing in the trenches, so to speak, is very positive.
And also, Mark, of course, we've seen the likes of Jamie Dimon and others start to refer to gold and Bitcoin in the same sentence. And that is intriguing, that both of them might be considered flight to safety assets. Bitcoin, of course, represents more than 50% of the total capitalization of this space and does tend to drag the CCI 30 index up, drags the alternative tokens with it to a degree. And there's starting to become quite a common narrative around that. And as you say, at Token 2049, the discussion around the regulatory outcome was interesting. For the first time, they said is neither red nor blue, but purple, the view on the space. And that is encouraging to hear, because that does play out solidly in the marketplace. But as you say, what really plays out in this marketplace is liquidity. And would I also say that it's fair to say that the process of the cycle of Bitcoin halving plays out? And if that's the case, Mark, where are we up to with the last quarter? Here we are in October, going forward for the year. What are your thoughts on that?
I think we've had even though it's 9 months into the year, I think if you take a look at the past 12 calendar months, you've had a tale of two halves, where you've had a strong bull market between October and March. And then you've had this market it hasn't been a bear market, it's just been choppy and sideways, where you've had weak April, relatively strong May, weak June, 1 month up, 1 month down, but we haven't really gone anywhere. If you traded it between 53,000 and 70,000, which is almost 10% in the middle, would be 60,000. I think what we've seen is a consolidation, and I do feel that with both the continued increase in the quality of investor, the institutional investor, as well as what you're seeing with flows into the ETFs, as well as you noted with when you came back from Token 2049, there's various algorithmic trading platforms that are being developed, the tokenizations coming. So there's like a lot of new and exciting developments that we'll only see in the mainstream in the next 6 to 12 months. So our opinion and my belief hasn't changed, in that I think going into the end of this year, we're setting ourselves up for the next leg up, and in this market, as well as into 2025. I think depending, there's always the caveat on, depending on the outcome in the elections, which are in less than a month, so the 5th of November in the US. And that, I think there'll be a lot of noise up until that point. And the other caveat is depending on how much this conflict in the Middle East starts sucking in all the various neighbors and potentially whether it's NATO and the G20 and so on. But I do believe that there's the perception, which is always, as you say, the price and what markets are trading at. And then there's this underlying reality of what we're seeing in the space in terms of the rollouts, whether it's with indexes, whether it's with a new product. And I do believe that it's very healthy. The ecosystem is very healthy. There's a lot of angel investment and VC investment once again into the space, whether it's in storage solutions. There's still the yielding and staking products. We've seen an evolution in custody from just, it was very challenging, to now with the various vaults, you can even trade on exchange without even moving your assets out of custody. Yes. And these are they're important developments because it creates, number one, a level of safety for not only investors, but also it enables fund managers, traditional fund managers and institutions to start finding ways to create product in the space. My view is, Deryck, I don't know where the market, I can't call the market in terms of price, but I do believe that if I look at the underlying fundamentals, they're very healthy. And right now the risk is firmly to the upside, particularly where we are in the rate cutting cycle and where we are in terms of retail interest, because retail interest has been very muted since 2022. And that feels like it's definitely coming back. And I think the ETFs have helped that. But there's also, we're seeing a lot of new funds with new strategies starting to come to market, which are very interesting for us both as a fund of fund as well as an actively managed fund, looking for opportunities. Because the more liquidity, it creates more, it enables that network effect. So overall, I think we're very bullish. Unfortunately, I think the next few weeks, particularly, maybe even towards the end of this year, might continue to be choppy. But the drift is definitely, if you look at the long-term drift since over the past decade, it's still up and to the right quite firmly with periods in between of sideways movement.
Yes, very much so. And it's interesting, having attended Token 2049 and listened to the panel after panel of discussions, one of those panels was the venture capital panel. And they made some statements indicating, I think, where the maturation period of this space is up to. And that statement was, we're no longer looking at layer 1 protocols or layer 2 protocols, meaning they're no longer looking at the base blockchains because they think there's enough solutions there that are very capable solutions to meet the requirements of the accounting or transactional process of this. And they're focusing on Web 3.0 and to a degree decentralized finance. That indicates they're going up the technology stack, which indicates that the technology stack is getting filled out and satisfied to the view of the venture capitalists. That was impressive. And then the venture capitalists' wonderful and selfless statement, which said there should be more hedge funds coming to market. And I laughingly say wonderful and selfless statement because when hedge funds come to a marketplace, it provides venture capitalists with an opportunity to exit large quantums or blocks of tokens. But again, that is a maturation of the market too. One of the statements I thought was interesting to investment panels there was that when would this industry start becoming valued and quantified in the same terms as an equity marketplace? And the answer to that from all of them, hands down, was not for the foreseeable future, because the types of investors in this space were more retail of mentality, but not necessarily retail. And they were investing in the future of the space versus a proposition of price earnings ratio or net tangible assets. And Mark, that's not dissimilar to how the giant Web 2 products were invested in the early noughties. And that was the investment into eBay and Facebook, obviously, Amazon, etc., which they were just thinking, if these people dominate the market, this group dominates the market, then it's worth a great deal, rather than calculating price earnings ratios. I get a sense it's similar. Do you get that sense too?
Yeah, I think there's two things. One, it might sound counterintuitive, but we actually don't want the big equity-like hedge funds and investors in the space, because then it creates a much more efficient marketplace, which means it's harder to generate alpha for the likes of investors like us or fund managers like us. Right now, with the volatility as high as it is, as well as the fact that there's so many different aspects to investing in the space, that whether it's some of the emerging technologies, how AI and decentralized physical infrastructure, not just Web3 adoption and gaming and stuff that people are talking about, but stuff that's a bit more esoteric and difficult to understand, like the sort of interoperability, and how this is going to continue to all play together, how it all converges to enhance the entire sort of blockchain ecosystem. So we'd prefer not having 1,000 analysts looking at the space. We'd prefer having, as we do, maybe 100 really solid analysts understanding the space, because it, number one, gives us opportunity. And then I think number two, to go to your point as to where we are in the cycle, there's always this explosion, as they call it, a Cambrian explosion of like new participants whenever there's this new technology. And we've seen it you saw it in automobile manufacturers, you saw it once again in the .com era. And then there's the consolidation, which is, I think, what we're still undergoing and what we've seen. But the challenge is this space moves a lot quicker, but also it's decentralized. So you don't just have developers that need big balance sheets, whether it's in industrialized nations. You can have some of the best developers are now coming out of the emerging markets, or you don't need 100 million to build out factory space. You can get away with building a proper protocol with less than $1 million of angel investment.
Yes.
So I think the applications to be built on this space, a lot of them are still not, I don't want to say haven't been conceptualized, but a lot of them are still in development, and where we're headed with the likes of tokenization and so on. What I think, Deryck, the one thing to bear in mind is that we've seen this debasement of currency. And I think we've seen in general a lack of trust of banks in terms of the security of your assets, as well as the continued printing of money and where that leaves us. So I think investors have been looking for alternatives, but the space generally is still quite small. So it doesn't allow for big investors to move significant chunks of wealth through that. But as time goes on, as you see the costs in the space and the applicability, the optionality, should we say, continue to, and it's moving exponentially. I think at some point it's going to just become so ubiquitous. You've mentioned it before. We used to talk about, social media companies. We don't think about it like that anymore. It's just part of our daily lives. If you go back 50 to 100 years, most people met their partners or spouses via their community, their church, friends, things like that, maybe family. Today, the vast majority over the past 10 years have been meeting their spouses. The dating apps, it's online, right? And most people connect via business online. We connect with people all over the world via LinkedIn, etc. So it's become, we don't think about it. We don't sit there and have this like, it's changed to this degree that we're only going to go this route. It naturally forms part of how things move forward. And that's what I think people are missing, is that this underlying technology is just naturally going to take the place of what we call the general dual ledger bookkeeping system. It's happened in a lot of instances already, but we're just now trying to figure out how do you monetize that. And the really great thing about this is I think it takes away a lot of the ability of large institutions. You mentioned Jamie Dimon and the banks and others that have been pushing against this, the likes of the Elizabeth Warrens and that have been pushing back against this.
Yes.
I think it's like you're pushing back against the weather. It's not going to make a difference what you think. It's going to happen. It's just a question of how are you going to navigate in this new world, because it's going to become the underpin. It is the only way forward that makes sense. Developers, costs, transportability, everything that makes up a very viable and solid ecosystem is already in place. Now it's just what's going to be built on top. And who's thinking of the next Netflix or YouTube? Or Netflix was a mail order system. I used to change videos in London at a kiosk at the train station. That was how Netflix started. This is 2003. 20 years later, take a look at what it's become. No one imagined it in this position back at that point in time.
Yeah.
So I'm very excited about the applications. How we'll monetize it, we're working on that frantically in both funds.
Exactly. And we will always continue to work on it because, as you say, the statement regarding things becoming ubiquitous, maybe in the future, if we're going to transact our house, we might want to ask which platform, which blockchain it's going to be transacted on. But otherwise, the vast majority of the transactions that we'll be doing, we won't be asking which blockchain it's operating on. It'll be ubiquitous. It'll be operating underneath. And in relation to institutional investors, the space is still too small. 56% of it is Bitcoin and 14% of it is Ethereum. So what's that? That's 60, 70%. There's only 30% out there that is not those two. Some of that is the colourful nonsense of meme tokens. And so you take that out of it. By the time you get down to it, there's about $600 billion worth of alternative coins, in other words, coins that aren't Bitcoin, that represent business strategies and technology strategies that institutional investors can invest in. It's too small. They're not arriving until it's sizable. The lovely thing about that for the audience that's listening is that means for the first time in evolving history with new technology coming out, it's not the institutions, the private investment companies and the venture capitalists that have exclusive access to an early stage liquid marketplace. First time in history. It is digital assets. And so for some time, we as a small fund and investors as small investors can be ahead of institutions and ahead of many of the venture capital groups and be able to invest in the space. What is important? Knowledge. Constantly learn. Education and knowledge, which we never stop doing, do we, Mark?
No, and I think the space is also evolving at such a rapid pace. There's always something new on the horizon, some new thematic that's playing out. I think what I like most about this space is that it's not about trying to grab a larger slice of the pie, so to speak. It's that the pie is expanding at such a rapid rate that wherever you place yourself, you should be able to access great opportunities, whether you're very focused. I mean, we've got thematic funds that focus solely on like Web3 and to an extent gaming and so on, consumer driven. What are the next apps from that perspective? And then we've got funds that are purely trading funds, momentum driven ETF type funds. And then we've also got, as we've been speaking about within our own fund, we've got fundamental strategies, we've got hedging strategies. We're looking at the options market and how that's matured. We now have option premium extraction strategies. There's a lot of room for growth. I think when you take a look at something as a snapshot at a certain point in time, it can just be noise. It's like looking at Amazon back in after the dot-com correction and when it's still an online bookseller. And then you start slowly zooming out. And when you get to 10, 15, 20 years worth of data and you look back, it's like it's so obvious that you should have bought Amazon back in 2000, 2001. And even the massive corrections you saw, like in 2018, you had the tech wreck, it dropped like 30%. It was irrelevant. Like in the long term, the pattern is clear. So I think we've always said we have a thematic view of the world, and you want to catch the big themes. You want to ride the big thematics whilst picking the best performers within that and managing your risk to the downside by targeting a certain amount of volatility. And I think if you look at traditional fund managers and what they're chasing in terms of yields, whether it's in real estate, equities and fixed income, the passive is now dominating that. The passive market probably dominates, I'd say at least 60 to 70% of flows now in the equity space. So fundamental analysis is, it's almost meaningless. It's just make sure you get on the right side of liquidity. But the next unicorns, the next big hitters will come from the space. It's just, it's a matter of, not just a matter of time, but it's a matter of probability. If they're flipping a coin 10 times and hoping to get heads, we're flipping in this space 10,000 times. And it's just a numbers game. Over time, this is clearly going to emerge as a winner. It's just a question of how do you monetize it? That's always the question. How do you create the risk-adjusted return you're looking for? And there's so many different ways of doing that in the space. You don't really want the big institutions here. They just destroy margin and crowd out the private sector.
Yeah, very good. Very true too. And with $650 billion there to invest in, it's not a big enough sector for them in so many ways. So that will keep them out, hopefully for a period of time. But as you say, it's rapidly growing. I would refer to this space, as I often do, and that is that this space is like Darwinism on steroids. It grows, builds, collapses, rebuilds, and represents a stronger, better, more effective system, product, solution, time and time again. If we were looking at the banking system, it would do one of those cycles in 10 years. And that's the reason why this space is growing so incredibly fast. So long and short of it is, September was a good month then, Mark. October and the last quarter and the early quarter of next year looking solid too. And we look forward to providing our next report on the October month in November. Any final words, Mark?
I think we've covered quite a bit in terms of the conferences and so on. I think what will be interesting to see for me, regardless of the outcome of the US election, is the implementation of policy. I see Coinbase is actually suing the SEC and Gary Gensler, which is good news. The shoe's on the other foot. So I'm keen to see how the regulatory environment changes. I think there's one of the big developments we haven't really spoken about is the biggest custodian in the world, which is BONY, the Bank of New York Mellon. They've now secured SEC approval to custody digital assets. That's going to be a game changer for a lot of funds because it's definitely, it is the tier one custody. So I personally feel like we're at the beginning. We've hit the tipping point. People can say, is this technology going to be around? That was the question, is would it survive 10 years ago, 5 years ago? And then you saw the correction, the crypto bear market of 2022. And after FTX failed, there's no bailouts. There's no government agency stepping in to shore up your balance sheet. There's none of that. And the industry did survive on its own. So the ecosystem, if anything, is way more resilient than anything you'll find in terms of the traditional finance world. And if we take a look at now where real investment is going into and where real skill is, my gut tells me that we're at the beginning of a massive surge in adoption and uptake over the next, and we're hoping it'll be for longer than a couple of months because the bull markets are quite short, it seems. But I think in this next wave, we'll see sustained investment for 12 to 18 months.
Very good. Thank you very much, Mark, and look forward to doing this, of course, again in November and giving people an update on where we think the market is to the plans that we've outlined then and a background on what's happened in the month of October. See you in November. Bye for now.
Good. Take care. Ciao.